Hey everybody, and welcome back to Investing with Wesley. I am super excited in making this video because in today's episode, I'm going to teach you about how to find the perfect value stock. Let's get into it. Okay, so for starters, you might be wondering, why would you want to find a value stock? Aren't all stocks valuable? And I don't mean valuable like that. I mean value. There's a difference between growth stocks and value stocks. Now, typically, most people will want the growth stocks. That's where they all flock to. The big tech companies like Apple, Tesla, Microsoft, those are all growth stocks. However, growth stocks are known for operating on a lot of debt. And I've made plenty of videos explaining to you why value stocks, in my opinion, are greater. Specifically, one video I made talked about how typically every 10 years or so, there is a switch on which kind of stocks outperform the other. Now, for a very long time, almost 2 decades, growth stocks have blown value stocks out of the water as far as how much they grow. But we're seeing early stages of that flip where value stocks will probably take off. And not only that, but the Fed says they're probably going to raise rates at least 3 times this year alone to combat inflation. And obviously, if you're raising the interest rates, all the people over here on the growth side holding massive debts are going to be in a lot of trouble. So needless to say, there's a lot of different variables leading us to believe that value is going to be the better option. So how do we pick an appropriate value company or value stock? Well, there is 6 different things that you have to look for when choosing an appropriate value stock. Number 1, you want to look at PE ratio. Specifically, you want a PE ratio lower than 20. Next, you want to look at the PB ratio. That is the price to book ratio, and you want that ratio to be 3 or less. Next, you want to look at the price to FCS. That's price to free cash flow ratio. And just like the PE ratio, you want that to be 20 or less. Next thing you want to research is the PEG ratio, and that ratio should be 2 or less. The closest to 1, the better. You want the ROIC, return on invested capital or cash, to be 10% or greater. And finally, the gross margin, you want to research and make sure that it is greater than 50%. Those are the 6 things that you want to research when researching the fundamentals of any company. But if they're within those number categories, like I said, that's how you know you have a really good pick on a potential value stock. Now, real quickly before we get started, I want to go into a little bit more detail on each one of these categories and what it exactly means. The PE ratio stands for price to earnings ratio, and that is the ratio that determines the share price versus the amount of earnings per share that the company gets. The PE ratio is important because it's one step that helps you understand whether or not you're buying a stock that is potentially overvalued or not. Now, the next one is the PB ratio, the price to book ratio. This one's important because it does more than just look at the earning potential and the price like the PE ratio does. The price to book ratio compares the market price of the share to the actual book value of the company, or in other words, its net worth. Now, like I said, you want something close to 1 as possible. Too high above 1, you start hitting growth stock companies with extreme amounts of debt. Too far below 1 into the negatives, and you could see if a company is in distress or not, and it could potentially be close to defaulting. Now, the FCF ratio, or price to FCF ratio, is, like I already mentioned, the FCF stands for free cash flow. And this ratio is determined by taking the share price and dividing it across the free cash flow of the company. But ultimately, it gives you a number that will help you determine if a company has a lot of cash flow or not. And obviously, the more cash flow, the better. Now, the PEG ratio is the price to earnings to growth ratio. It's kind of the next step to the PE ratio. Now, when it comes to the PEG ratio, a ratio of 1 is a fair price. Anything more than 1 determines that the price of the share or the stock is a little bit overvalued. Anything under 1 determines that it's undervalued. And lastly, we're going to talk about the 2 of them on the list that aren't ratios. The first one is the ROIC. You want the return on invested capital to be north of 10%. And the ROIC basically tells you that the money that the company kept for itself to grow will tell you at what rate that money grew. So if they kept several $billion and had an ROIC of 10%, then that $1 billion they kept behind helped their company earn and grow by 10%. Now, the gross margin is an important one. How you determine the gross margin is you take the price of the goods sold minus however much it costs to make those goods, and then divide the whole thing by the price of the goods sold. Now, the ratio and the number, I'm not really going to get into, but the point is you want a really good gross margin because it determines the profitability of future products that that company sells. A really good gross margin means better income and better growth in the future. So when picking the best value companies, you want companies that will pay you a good dividend, but will also keep enough back to help their company grow. And then you want to look at their growth rate to determine if what they're doing as a company is even working. And then you can make your determination whether or not the share price is fair, if you see good growth in the future, and if it's worth investing your money into or not. Now, for the remainder of this video, I want to give you a side-by-side comparison on what Warren Buffett, the king of value companies, invests in, and what all those metrics that I just talked about look like on his stocks. And then I'm going to show you some of the value companies that I'm currently investing in my own portfolio, and the metrics in those companies. So let's get started. First off, one of the all-time favorites that Berkshire likes to invest in is Coca-Cola. Now, Coca-Cola has a PE ratio of 29.75, a PB ratio of 11.55, a price to FCF ratio of 19, a PEG ratio of 2.79, an ROIC of 14%, and a gross margin of 60%. And currently, Coca-Cola pays about a 2.79 dividend. Another classic that Berkshire likes to invest in is Verizon. Now, Verizon has a PE ratio of 10, a PB ratio of 2.8, the FCF ratio is 9.9, the PEG ratio is 2.9, the return on invested capital is 8.31, and they have a gross margin of about 58%. Lastly for Berkshire is PG, Procter Gamble, another classic value company that a lot of people invest in. They have a PE ratio of 29.7, a PB ratio of 8.78, an FCF of 27.5, a PEG ratio of 4.13, an ROIC of 13.75%, and a gross margin of 49.04%. PG also pays a dividend of 2.14%. Okay, so you noticed that the stocks that Berkshire is investing in, they're not all perfect and they're not all hitting those metrics that we talked about, but they are hitting the very important ones, like return on invested capital and gross margins. They also pay a pretty average dividend of about 2%, with Verizon being the exception of closer to 5%. Now, finally, let's look at a comparison of some of the value stocks that I'm currently investing in and see how they compare. The first one is Progressive Insurance. They have a PE ratio of 14.93, a PB of 3.2, an FCF ratio of 7, a PEG ratio of 4.8, an ROIC of 6.97%, and a gross margin of 38%. But they also pay a 6.14% dividend. Now with this stock, you see that the PE ratio, the PB ratio, and the FCF ratio are all well within the numbers that we want. Now, admittedly, the kind of more important thing is the return on invested capital and the gross margin, which are a little bit lacking, but that's kind of to be expected considering they're keeping less cash for themselves than, say, Coca-Cola. Because they're issuing a 6% dividend instead of that 2% dividend, they're keeping less, meaning less is going to grow and they'll profit less from it. But looking at the long-term time horizon of Progressive, you can see that it is very profitable and continues to do good. The next one I chose is Altria Group, which is a tobacco industry stock. The PE ratio is 15, while the PB ratio is 0, meaning when I bought this company, it was undervalued. The FCF ratio is 10, while the PEG ratio is 2.7. Again, hitting all those metrics that we listed earlier. Now their ROIC is 25% and their gross margin is 53% as well. So it is well within those two metrics again. Now you might be thinking if it hits all these metrics, it's probably not got a big dividend. But contrary to what you might be thinking, it actually has a dividend of about 7%. So just based on these metrics and what I've seen this company and this stock do long term, it is probably one of my favorite purchases. And lastly is OneMain Financial with a PE ratio of 5, a PB ratio of 2.21, an FCF ratio of 3.16, a PEG ratio of 0.61, a pretty lacking ROIC of 7%, but a great gross margin of 80%. And what this tells me is that over the past couple of years, the profit of this company has been lacking, but the prices have been good and calculated well. Now, what could this mean? Well, OneMain Financial issues loans to individuals and businesses, and with interest rates being so low, the profitability and return on their capital hasn't been as significant as it could be in the future with the raise of interest rates. And with it checking the boxes on every other metric, I thought it would be a perfect buy in the expectation that interest rates will inevitably rise and the potential profitability of this business will go up as well. I hope you got value in this video. If you did, please remember to like and subscribe as it really helps this channel get out there. I think currently my statistics say that about only 5% of my viewers are actually subscribed and the remaining 95% are not. So if you're part of the 95%, go ahead and hit that subscribe button for me because it really does a lot in pushing this channel out there so that I could help educate all of you guys much better. Either way though, the choice is yours, and I'll see you in the next episode.